Hi, I'm Alan Weiss, and if you're a property investor using a self-managed super fund, you need to hear this. The Albanese Government is proposing a new super tax called Division 296, and it could hit investors harder than most people realize. Here's the short version. If your super balance is above $3 million, you could soon be paying 30% tax on unrealized capital gains. Yes, on paper profits, not rent, not dividends, just the rising value of your property. Even if you haven't sold it and haven't made a dollar from it. Let me give you an example. Let's say you own 2 units in Rose Bay in your SMSF. They grow in value by $500,000 over a year. Under this proposal, you could be taxed $12,000 to $15,000 on gains you haven't received. And if the market drops the next year, you won't get a refund, just a credit. Now this might sound like a tax for the ultra wealthy, but that's a smokescreen. The $3 million cap isn't indexed to inflation. So with Sydney real estate rising 4 to 6% annually, plenty of smart, middle-class investors will cross that line just by holding long-term. The real risk? You're forced to sell too early, pull money from other assets, or take on debt just to pay tax on something you haven't realized. And let's not forget, real estate isn't like shares. Valuations are messy, inconsistent, and open to dispute. Who decides what your property is worth? This isn't just a tax issue. It's a threat to retirement planning, investor confidence, and the entire concept of super as a stable wealth building tool. So what can you do? Speak to your accountant. Review your structure. Look at alternative vehicles like discretionary trusts or companies. And above all, stay politically aware. This proposal hasn't passed yet. But if it does, the fallout for property investors could be serious. I'm Alan Weiss. I've spent 35 years helping clients grow wealth through property, and this is one change I wouldn't ignore.